Hello everyone, welcome to my first video, or well, it's not really my first video, but one of my first videos on this channel. Today we're going to talk about Google stock, or basically Alphabet stock, Alphabet Class A, just so you know. We're going to talk about Google stock because I think it's a very interesting company, it's a very innovative company, and it's also a very attractive company for the investor, as we're going to see, in a minute here. Now, there is no investment video without a little disclaimer. So, I advise you to read this. I have also a little disclaimer myself, which is I own Alphabet stock. So, just so you know, okay? So, you can see that as a sign that maybe it is a good company. But some people also see it as a sign that my opinion is biased. Now, I'll try, of course, and it's not that convincing maybe to the people that really believe in that I'm biased, but I'll try to stay as unbiased as possible. But that's all I can say. I can't prove to you I'm unbiased, at least if you're looking at the video. But yeah, so just so you know, I own Alphabet stock, and I'll try to stay as unbiased as possible. I'm not responsible for any investment choices you make based on this video, and I always advise to do further research. Investment comes with the risk of losing capital. What we're going to talk about today, we're going to talk about the competition, really short, running projects, what is Google's business, the financials. We're also going to look at the leadership after what's Google's business, and then we're going to have a conclusion. Of course, we need to have a final verdict on the company. So competition. Whenever you think of the competition of Google, what companies do you think of? Maybe something like Apple, Microsoft, Oracle, Tesla. Those are all valid companies. Those are all valid picks. And it's true. Alphabet has many enemies. Nah, it's just that Alphabet is a very big company. It's a mega corporation, and it has a lot of projects running. So obviously, kind of as a consequence to that, they also have a lot of competitors. So, what projects do they have? What project does Google run? Well, they have Waymo, or Waymo, whatever. It's their autonomous vehicle project, which is competing with Tesla, of course. Calico, a biotechnology project. Not much is known about this project, by the way. We'll see that later. Gemini, which is their AI, artificial intelligence, of course, competing with Microsoft. Mandiant, cybersecurity. It's technically a company they bought in 2022. And Google Nest. And they have many more projects. They have many more projects than just this. But it's so many. I cannot possibly fit all that in this single video. If I would even try to do that and go into decent detail, then this video would easily take 12 hours. So we're not going to do that, of course, but we're going to pick out some interesting projects and some of the most important projects that they are running currently. So Waymo. Waymo is our autonomous vehicle project. You see on the screen here a Jaguar that's fitted with all their technology and autonomous vehicle related tech. It's a 14-year-old project, and its current valuation, well, it's not really current, but because it's a project, it's not continuously valued. But it's a $30 billion in April 2021. Its estimated annual revenue is about $1.4 billion with a total funding of $5.5 billion. Now, obviously, it can have an estimated annual revenue because it's still an innovative project. It's still heavy on R&D expenditure. It's probably losing money. It's not making any money. It's probably more or less losing money. I don't think they're gonna outcompete Tesla. We'll have to see. Calico. Now, Calico is a biotechnology project. It attempts to increase vitality. It attempts to decrease aging. It's an anti-aging biotech project. It's about 10 years old, and as I already said, there's not much known about this. You can look it up yourself. The Wikipedia page is relatively short, so it's just a project not many people know of even. When I was looking into projects and I found this one, I was like, wow, I never heard of this. So I don't know much about this apart from the fact that it's attempting to increase vitality. It's 10 years old and it's a biotechnology project. Google Gemini, or Gemini, which is a Google DeepMind project. It's an artificial intelligence project, and it attempts to beat ChatGPT, or GPT-4 actually, or it beats it. We'll have to see in the next slide. The release video was quite a flop because when they released this, at first, it looked like Gemini was beating GPT-4. However, what actually happened was that part of the video was faked. And that came out, and as a result of that, people started doubting Alphabet and the results. Now, if you look at the results or the statistics, it looks like Gemini Ultra on the right here. You can see the percentages. In the blue is that it's beating it, and Gemini Ultra, which is Alphabet's, is beating GPT-4, at least on most tests. It looks like, but because this is well done by Google itself, it cannot be independently validated. And given that the video was partly faked, it's very difficult to believe that these statistics are actually true. So we'll have to see by an independent party if these results are actually true. Now, also, as a little nuance to it, it is talking about Gemini Ultra. Gemini Pro, which is their consumer-friendly part, probably we'll get to use basically speaking, is more comparable to GPT 3.5, which has been out for quite some time. In addition to that, to make matters even worse, Microsoft is already working on GPT 5, so Alphabet has to really step up their game if they're willing or want to beat Microsoft to it. So they'll have to invest quite some money into this and invest quite some human capital to it to actually beat Microsoft, because right now it's looking like they're in the race, but it's looking more like they're gonna be second than first. Mandiant is a cybersecurity company that they bought in 2022 for 5.4 billion US dollars. It's about 19 years old, and its revenue in 2021, of course, because now it's reported on their income statement, so we don't know, because now it's just grouped under Google Other or whatever it's grouped under. So its revenue in 2021 was 500 million almost. Now, the reason they bought Mandiant is for Google Cloud business, and I think that this was a really good purchase. This really showed that Google was willing to step up the game in the Google Cloud space, or in the cloud space in general. So, in my opinion, one of the best moves Google has done in recent years. Google Nest. Now, there's not much to be said about Google Nest. It's just another smart home appliance thing, kind of the same what Amazon is doing. It was acquired in 2014 for 3.2 billion US dollars. And in 2018, this is actually a funny story. In 2018, Wall Street analysts were able to somehow, from the income statement, figure out that the revenue generated by Google Nest was 750 million. Of course, we're assuming it went up, and it's probably more nowadays, but we don't know, because in the income statement, it's just grouped under Google Other, so we can't really know a specific number. But in 2018, Wall Street analysts were able to figure it out. Now, this is a little thing I just put in here. 8 Pillars of Innovation is a document Google released. Well, I'm using the terms interchangeably throughout the video, just so you guys know. Google and Alphabet. Of course, Google is a subsidiary, but I'm just going to use the two terms interchangeably, so just so you know. But the thing I found most important was point 8, which is never fail to fail. I think that's more or less inspirational, that to achieve success, it's okay to fail, it happens, And perhaps it's also good because at least when you fail, you know you've tried some. So whenever you fail, don't see it as a failure, but see it as part of your success, I guess. What is Google's business? We've talked about the projects. We've talked about what they're up to, what they're doing. So let's see, where does Google get their money from? Of course, very important stuff whenever we're looking into companies we want to invest in. So whenever you think of what Google's business is, you think probably of search engines, YouTube, Android, and other technology related stuff. And really, it all just comes down to innovation. They're a very innovative company, as every technology company is, and they're trying to get into new fields, create new fields even, and generate income from that. Now, if we're going to look on the income statement, and we're going to look where they get their money from, it's actually a relatively boring company because 80% of their income, which is Google Ads, Google Network Ads, and YouTube Ads, is advertising. So they're an advertising heavy company. Next to that, they also get income from apps, hardware, content, and Google Cloud, but that's only 20% or almost 20%. Their total revenue is about 280 billion, almost 300 billion, which is a lot of money. When we look at this, right, we'll think, oh well, they generate a lot of money. That's a good thing. Yeah, well, that's a good thing, of course. We would like to get part of that, but we have to look at it in relative change. So we have to look at what was the income last year, and the year before that, and the year before that. Heck, what was the income a decade ago? Because that actually tells us something about the trajectory the company is going to follow. And if we look the revenue on a graph for previous few years, we actually see something very interesting developing, which is this part here. We see that it was exponentially growing, slowly but surely. Eventually got a big bump in 2020, of course. Not that surprising, really, because during the COVID pandemic, what did everyone do? Everyone went on the internet, everyone went to Google search engine, everyone watched YouTube videos, everyone, so obviously their income is going to grow in that period. Now, what's interesting, they've continued to grow even after the COVID pandemic, but the growth has somewhat slowed. That, of course, begs the question, what is happening? Why isn't the growth continuing to grow? So if we look at the year-on-year quarterly growth percentual, then we see that every quarter it's about, or every year I should say, it's about 20%, sometimes dipping below, sometimes way above, sometimes a little bit above, sometimes even a little bit of a downturn. Then we see a pyramid, so this is the COVID pandemic, so their growth went really high. Then it went down, and here we see a bit of a downturn. And do you see it picking back up? We do see a little bit of picking back up. So we'll hope to get back to the 20% here. But what's really interesting about it is maybe what just happened is just that this growth was so big. Because remember, even though growth is slowing, it's still growth here. Maybe what just happened is just the markets kind of went up a lot, and then it just got saturated. Well, not really saturated, but it had to kind of adjust for the sudden enormous growth and just slow down a bit. And now it's picking back up to normal levels. So, is there a lot to be afraid of here? I wouldn't say so. I wouldn't say that this is really concerning. If you're going to look at why did the drop happen, it was a drop in YouTube ad revenue, and a slowdown in general ad revenue because of the 2022 economic, well, at least projected recession. A lot of companies were scared. They thought, oh no, we're going to have a recession soon, so we'll have to save a bit on advertising, or we'll have to save a bit on money. And usually the first thing companies save money on is advertising, because it's really easy to save on. It's something that doesn't involve a lot of work to save money on. It's just, okay, well, we're going to spend less on ads. Remember that advertising is 80% of revenue of Google. What I mean by this is that a minute change in ad revenue has enormous impacts on Google's entire income. And Google knows this. Google is realizing this. And that's why they are diversifying their whole product portfolio. That is why they're going into new fields. That is why they have gone into new fields, even a decade ago. But first, we're going to look at Google's cloud business. Now, Google's cloud business has gotten a lot of hate, alright, from investors at least. Why is that? Well, Google's cloud business revenue grew year on year in Q3, which is the most recent data, to 22.5%. And normally we would say that that's enormously good. That's very good even. Well, Microsoft Azure's growth is about 31%. So it's less than Microsoft Azure's. And it's about the same as AWS, which is Amazon Web Services. A positive note is that it's finally profitable. So that's very good. But its growth is not as fast as Microsoft's Azure. And an important thing in the cloud business that people have to understand is that monopolies win. And you can see that currently Google's cloud business is third in the rankings on size. That's not good. You want to be first, and if you can't be first, you want to be second. But you don't want to be third, you don't want to be fourth, you don't want to be fifth, you want to be first or second. Because monopolies win in the cloud business. Now, why is that? Well, that is because developers learn to program for the largest cloud technology. So like AWS or Azure or Google Cloud. So in this case, it's AWS. So that makes it more enticing for certain companies to say, hey, there are a lot of developers that can program on Azure. Not a lot for Google Cloud. So what's the most obvious and easiest pick? Well, it's going to be Azure. Also, customers or companies are stuck to a plan for a prolonged period of time. So they'll basically pay for a 5-year-long plan to stay at a certain cloud business. And after that, it becomes incredibly difficult to switch because everything in your business has been centered around Azure. Then switching all that to Google Cloud is an enormous hassle. So you don't see a lot of companies switching after they've signed a plan. So that is why you have to be the first or the second in this business. And if you're not, well, you better get your game on, because then if you're not gonna try to become the first or the second, you might as not try at all. That is why being third is an enormously dangerous position, because it's Tencent Cloud, for example, which is what, like 8th in the ranking, they only have 2%. And at that point it's kind of like, okay, well, you have that business, but who really cares? Right? Who really cares? But as the third, this, by the way, a different graph I see now. This is the Q3 and this is the Q2. So we're just going to get the Q3. But at this point, it's kind of like, if you're 8th, who cares? You're not going to invest that much money. You're not going to do that much with it. You're not going to center your business around it. It's just kind of the thing you have, and whatever. You'll just have it run as long as it's profitable. But if you're third, you're actively investing money into it. You want to be second. And if you lose that second or first spot and you're not going to make it, then you've lost a lot of money. So the third position is really, really dangerous. And that's why Google Cloud either has to get their game on and really, really heavily invest into it, or they should cut it right now and just let it die out, slowly but surely. Now, the other business, of course, not only Google Cloud, we also have Google Android. And there's not much to be said. Solid for years, no concerns whatsoever. It's just in happy harmony with iOS. If we look at the acquisitions, and it's just an well, not really an important thing, but just an interesting thing to look at because, of course, they're innovative companies. They're broadly diversified. We want to know. So compared to other competitors, we see that in the past 2 years, Alphabet has had the most acquisitions. Now there is a bit of a nuance to this, and as in the previous 3 years, I see that Microsoft still has past 3 years there, but actually two. In the past 3 years, Microsoft had the most acquisitions, but in the past 2 years, it's Alphabet. So in total, we see that Alphabet has had the most acquisitions. However, they didn't spend the most on those acquisitions. That was actually Apple. Now, what makes this very interesting is that apparently from what we can see here, is that Alphabet likely buys up companies for relatively cheap valuations, and usually in early stages of the business. While Apple, for example, buys up companies, well, they have developed and matured and proved they have a decent market and very likely are going to turn profitable. So we see kind of like a notion difference there. That Alphabet is more innovative, perhaps you could say, or more risk taking than Apple. And you can see that as a very positive thing. You can also see it as a very negative thing, because you can also see it as, okay, well, so basically Alphabet is burning money because a lot of the companies basically don't make it. So that's a difference you'll have to accept maybe, or a difference you'll have to see, and you'll have to pick which one do you want. And I think if you're looking into innovative companies, Alphabet is the obvious pick here. Now, if we look at the past acquisitions, the past few, we see a lot into Google Cloud and into artificial intelligence. That's very good, because I already said their Google Cloud business is third in the ranking. They have to get their game on, and they obviously are seeing that, and they obviously are willing to do something about it. The same for AI. So this is a good thing. I really like to see this. They're investing into AI, they're investing into Google Cloud. Very positive, but we'll have to see if their investments come to fruition, because we're currently not seeing that in the Google Cloud ranking. Neither are we seeing that in the AI, because they faked those videos, as I already told you. And also, in addition to that, they haven't publicly let an independent company or an independent party verify the results. So we'll have to see if those investments come to fruition, but we don't know for the time being. And that's, I guess, the magic of investing. So, Google's business rating. We see a strong app monopoly, we see a strong foundation, which is something I do like to see, actually. Possible AI beat, we don't know for sure. And Android OS was a solid position, not much else to be said. Strong other projects like Nest and Mandiant, and steep competition in the cloud space. So I give it a solid B. And why do I give it a B is because of the strong ad monopoly. There's no one beating them to advertise. And also what I like to see is that they're actively competing with other companies. They're actively competing with Microsoft for AI, and also actively competing with Microsoft for the cloud space. So that is why I give it a B+. It's a very solid company, strong app monopoly, strong foundation, and they're trying to build on top of that. Now Google's leadership, because of course leadership is very important for a company. In the eventual verdict, it's not that big of a factor, but I'd just like to talk about it. The CEO is Sundar Pichai, VP CBO is Philip Schindler, and CFO is Ruth Porat. I'm not going to talk too long about this. Sundar Pichai is about 51 years old, joined Google in 2004. He's an okay CEO. You know, he's not that notable, he's not that special, he's just okay, he's good, he's obviously a smart man, but all CEOs of mega corporations are very smart people. He's an okay CEO, and there's not much more to be said about him apart from that. He's not very special, he hasn't had any very special moves that he did. For example, if you look at Disney's Bob Iger, he's had some acquisitions that have been very profitable to the company. And Sundar Pichai just doesn't really have that magic. So he's okay, but nothing special apart from that. Now Philip Schindler, not much to be known about this man. Even Wikipedia doesn't even know how old he is. They say like he's 52 or 53, one or the other. There's not much known about this man. He has an MBA from the European Business School, obviously very smart, but not very special as well. And out of the three, and I'm quickly going through it because I think Sundar Pichai and Philip Schindler aren't really that interesting, to be honest. But Ruth Porad is, in my opinion, the best of the three. She's the CFO since 2015, and she began her career at Morgan Stanley in 1987. She has the most experience out of the three. She's about 65 years old, or well, she is 65 years old. She has a Bachelor's of Science in Economics and International Relations at Stanford, Master of Science in Industrial Relations, and an MBA from Wharton. And she is very experienced. She has 36 years of experience, and I think out of the three, she's probably the best. Very skilled, very qualified, and a very good pick as CFO. What do I give the leadership as a rating? Well, we can't really say. We have to compare it to other companies. If we look at Apple and Microsoft, and here's where Google's leadership rating kind of plummets. Because if you look at Apple, they have Tim Cook as CEO. And Microsoft has Satya Nadella as CEO. If I get a list of three CEOs, Sundar Pichai, Tim Cook, and Satya Nadella, who am I going to pick? Well, it's not going to be Sundar Pichai. That being said, I give the leadership rating at Google a C minus, because a C minus kind of just tells me like it's okay, it's solid, it's sufficient, but not wonderful. So the financials, earnings per share at Alphabet is lower than Microsoft and higher than Amazon, but earnings per share doesn't really tell us that much when you're comparing the companies. So earnings per dollar for that is far more interesting, which is the earnings per share divided by the price of a share, or the PS as I've abbreviated to in this slide. The earnings per dollar at Alphabet are the highest, and that's very good. You want the earnings per dollar to be as high as possible. So Alphabet is beating Amazon and Microsoft to it at the earnings per dollar. If we're looking at the market cap, Alphabet is kind of in the middle. It's more or less the same as Amazon. And Microsoft is just really, really huge. It has an enormous market cap. Then if we look at the PE ratio, the price to earnings ratio with the TTM, trailing 12 month, PE ratio of Alphabet is 27.11. Amazon's 80.75 and Microsoft is 36.23. Now the price to earnings basically tells us the higher this number is, the more expensive the company is. So Alphabet is the cheapest out of the three. Now why have I picked Amazon and Microsoft? It's because they're the biggest competitors, at least in the cloud space, and Microsoft also in the AI space. So that's why I picked these companies. So Alphabet is once again beating Amazon and Microsoft. So the same was for the earnings per dollar. Alphabet is beating them on the PE ratio. So where does it stop? Well, not at the PEG ratio. Now, for the people that don't know, the PEG ratio or the PEG ratio is the price to earnings divided by the growth, percentual growth of the PE ratio in the last years. Now, preferably, you want a PEG ratio or PEG ratio below 1. If we look at the 12 years, the previous 12 years, so that's from 2022 to about 2010, no company fills that requirement. Every company is above 1. Now, if you look at the previous 5 years, there's only one company that is actually valid, and that is Alphabet. Alphabet has about a PEG ratio of 0.55, Amazon of 1.50, and Microsoft of 1.03. So, and Microsoft is about interesting. It's acceptable, but Alphabet is very, very good. Then we're going to look at the balance sheet, the debt ratio and the current ratio. Just so you guys know, the higher the number, technically speaking, the better. And if you look at the numbers with the debt and the current ratio, once again, Alphabet is the better company out of the three. But there's a bit of a nuance I want to give to this. And that is that the number that Alphabet has is so high that it tells me something else. It tells me that Alphabet doesn't really know what to do with their money. And that's really bad. It shows to me that Alphabet has so much cash on hand and so few liability that it doesn't know what to do. It doesn't know where to throw the money at. And I would know. I would throw it at Google Cloud. I would throw it at the artificial intelligence, Google DeepMind project. But Alphabet doesn't know what to do with their money. So either they're improving their balance sheet or they don't know where to throw their money. And I hope it's the first, but that wouldn't make any sense. because the balance sheet is already really good, as you can see. So I'm really afraid it's the second. I'm really afraid Google or Alphabet doesn't really know what to do with their money. And that's a shame, because it's a profitable company. If you look at the profitability formula, which is the EBIT, so the earnings before interest and taxes, divided by the total amount of assets times 100, we see that it's 20.48%. 20.48% is really good. With the average bank business loan, which doesn't really say much for a mega corporation, I must add to that, but just so you know, is about 6% to about 12%. So what I would do if I was the leadership of this company, I would use all the cash that I have on hand to make more income, throw at something, throw at Google Cloud, throw at artificial intelligence, and make a profit, because you are a profitable business. You have about a 20.48 profitability. So I would get in more debt, actually, and invest that money into divisions you want to grow. So the AI and then the Google Cloud space. That's what I would do. And I hope that the leadership will see that. Because right now, as you can see from these debt and current ratios, Google is sitting on a lot of, well, value here. Too much even. And that is that's really, if we're looking at Alphabet, the only thing I actually am kind of afraid of, that they don't know what to do with their money. Then if you look at the financial cash flow, or free cash flow, the price of free cash flow is the market cap divided by the free cash flow. And you preferably want this as low as possible. And you can see that Alphabet is winning at that once again. Alphabet has a price of free cash flow of $22.74. And Amazon and Microsoft's are way higher. Amazon is way higher, almost 4 times that. Then Alphabet pays no dividend, and I actually see that as a positive thing, because innovative companies must invest in their projects to increase stock price rather than pay out a dividend. So rather than paying out dividends, I want companies, innovative companies like Alphabet, technological companies, as well as Microsoft, to not pay out a dividend, because that somewhat forces a company to pay out a dividend every year. I want to keep them that money and invest into projects, and that way generate value for shareholders. So actually I think this is a good thing. Microsoft does pay out a dividend. I think it's like 0.81% or something. So not a really high dividend, but it does pay out a different dividend, and Alphabet doesn't. And I actually see that as a positive thing. So how does Google or Alphabet then provide value back to the shareholders? Well, does that by stock buybacks. Google is actually one of the most aggressive stock buyback companies. And this tells us that Alphabet is still willing to return value to its shareholders, just not in the way of a dividend. And I see that as a good thing, because dividend forces a company pretty much every year to pay out a new dividend, but stock buybacks don't. If next year Google says, okay, we're not going to buy back that many shares this year, very likely the stock price will drop, but not as significantly as if it would have said that it will stop paying out a dividend. The pros of stock buybacks is that it's more flexible than dividends, as I already said. Increases my relative share in the company. Stock buybacks have no immediate tax implications, which is really nice. Sure, you get capital gains, but dividends you immediately pay taxes over. But stock buybacks you don't. You only have it once you realize the gains. And stock buybacks obviously also increase the earnings per share. The thing with stock buybacks is that they have to be initiated at the right time. If you're going to do a stock buyback as a company when the stock is really high, like high as it's ever been, then you're going to waste a lot of money. So you want to buy shares when shares are cheaper than you think that the intrinsic value of the company is. That's when you as a CEO have to initiate the stock buyback. If the share price is really expensive, then it's more interesting to pay a dividend, because otherwise you're paying too much for shares and you're basically just throwing money at the meat grinder and losing money really fast. And if we're looking at the stock buyback price, we don't know the exact price they bought at, but very likely at a cheaper valuation than they are worth now. Because they started buying back shares in 2022 and in 2023. They spent about 70 billion, as you can see from the article here. Over the period of over this period here. Now, what I did find is that every quarter they spend about the same. So it was divided into 4 quarters. So it was about 15 billion a quarter. So they very likely purchased about here, 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 and so forth. And very likely, if you just look at the averages, they're in the green on that investment. Very likely, especially these shares bought here, were very good stock buybacks. So that's something that the leadership did very, very well. They saw that there was an opportunity to do a stock buyback, and they very aggressively did it because they were the company that did the most stock buybacks out of all companies that exist, even more than Apple, which has about 3 times the market cap of Alphabet. So that's very interesting to see. It's very good to see. Alphabet is still an innovative company. We have to look at the research and development expenditure because it's innovative. Duh. If we look at the R&D, we see that Alphabet spends the most out of these three. It spends 40 billion in 2022, Microsoft 25, and Apple also about 25. So Alphabet beats them on that, despite having half their market cap. However, when we compare it to Amazon, R&D expenditure is not as much. It has about the same market cap as Amazon, but R&D is about half. Take that for what it is, but it's still beating its one of its major competitors, which is Microsoft. So that's a good thing to see. They're actively spending a lot of money on being innovative. Then we have to give a verdict, conclusion, a rating. Alphabet has a high EPD, earnings per dollar, lowest PE ratio, best PEG ratio out of the three, excellent debt and current ratios, perhaps a bit too good. I'd like them to see them invest all that money that they have there. Cash flow is really, really solid, good R&D expenditure, and a lot of good, well-planned stock buybacks. So, what do I give the rating? A solid A. There's not much else to be said. This just deserves an A. It's really good. It's almost too good to be true. Maybe they are cooking the books there. They're cooking the AI videos. Maybe they're cooking the books as well. You don't know. No, I don't think so. It's a really good financial, from a financial point of view, it's a really solid company. So as a conclusion to that, business rating gets a B+, leadership rating a C-, and the financial rating an A. The weight of that is 0.4, 0.1, and 0.5, because I don't think leadership is that important, at least not as important as the business rating or the financial rating. And we get an overall rating of an A-, which it means it's a really good company at a good price. Once I've given this verdict, I need to repeat the disclaimer, and that is, do not base your investment on this video, do your own due diligence. With investing comes risk of losing all your money or part of your investment, so keep that in mind. I'm not responsible for any actions you take on the stock market, and, well, you can lose your money with investing, of course. It's a good company. That's our conclusion. A really good company. A really solid company with solid financials and a good business. Next week, Alibaba, 6th of January 2024, 5 p.m. Eastern. So if you're really wanting to see more, then you can check that out and wait for next week. I want to thank everyone for watching, and I want to just thank you. And don't forget to subscribe, like if you like this video. If you want to request a company for analysis, let me know in the comments. And well, thank you very much.